What typically happens when there are geopolitical shocks like the one we are enduring right now? How do equities perform over the medium and long term?
Well, the medium long term, they do fine. And in fact, in most geopolitical shocks, the impact has been quite short lived. If you look through 9/11, the beginning of the pandemic, the invasion of Kuwait, if you look at all of those events, they're measured in weeks and a couple of months. The real exception to that, if you look at, it's almost hard to declare a day, but let's say you start for the Lehman bankruptcy, and then you see a protracted downturn that took a couple of years for people to get their money back in the equity markets. But that's because that was a marker on the way to a long and protracted recession. So if we don't get a recession out of this, and we're in the camp of thinking it's reasonably unlikely, given all the factors you just discussed, the smaller impact of energy than we used to see, the continued strong economic growth coming out of the COVID recovery, then you're looking at a relatively short-lived event from an equity market standpoint.
I don't mean to put words in your mouth, nor do I mean to trivialize what's going on in Ukraine, but by implication, what you seem to be saying is that economic conditions, inflation, and interest rates, i.e. the Fed, are in the medium and longer term going to be the more important factors or vectors that we need to concentrate on.
I think that's true. And if you're looking for signs that that's sort of the way the market's thinking, think about this. We've had no Treasury rally. I mean, the 10-year is exactly where it was when the invasion started. And I'm from the school, if you talk about putting a bond portfolio together and you're looking for the big diversifier to equity, so you say go buy some zero coupon bonds, in case there's a pandemic or a war or something. Well, it didn't do a darn thing this time around. The impetus for rates to normalize is so strong that, we got a brief rally in treasuries. We got a little bit of flattening, but really very little. At the beginning of the pandemic, you had a much bigger treasury rally. It got somewhat unwound quickly. But, here we're not seeing a lot because the trajectory is likely to remain in place, hopefully, as we all hope for a political solution.
The ride on interest rates has been a wild one over the past couple of weeks, Steve.
It sure has. And Simeon, could you give me maybe a bottoms-up answer to a top-down question here, which is Goldman Sachs brought down its forecast to 1.7%, which is below potential. They brought it down by 0.5 point. They added another 0.7 of a percentage point to inflation. They said there'd be a big hit to consumption. What happens to company earnings in that environment if the pie is not growing as much as we thought the pie would grow? Now, I understand you may not agree with that forecast, but in any event, in an environment of the pie, the growth of the pie is getting smaller. What happens to earnings in that environment, and what happens to stock valuations relative to earnings?
So we're in a slightly better place with a 10% correction in the S&P, and we're trading at about 19 times 2022. Remember that even if the 10-year Treasury went to 2.5 or 3%, that's still historically low, and it would on average support something around a 20-ish PE. So overall, that's not a particularly expensive place to be. But yes, it does make sense to think about who some of the winners and losers will be at the margin. You put up on the screen some of the obvious sectors that if we have inflation that's somewhere between kind of the 8% that we just saw and the 2% long-run trend, so something that's modestly elevated, there's still some sectors, energy, of course, but also if you've got things like financials and materials that will likely have a little bit of a leg up. So you can certainly make some moves to tweak your equity portfolios, but even if earnings overall don't quite come up to where expectations were before the conflict began, it's likely not to be a big risk.
Simeon, I was making a joke with Tyler about it having been a lousy week. I wasn't alone in that sentiment. If you looked at consumer sentiment today, it was pretty terrible. What does that tell you about the outlook for consumer spending and some of the stocks that are linked to consumer sentiment?
Well, when you're looking at the consumer, First, it was important that we all noted how much smaller the energy sector is. So it certainly does have an impact on sentiment. But the good news is it's not the impact that we would have seen 50 years ago. But it's absolutely a piece of the puzzle. If the conflict goes on a little bit longer than we all think, that can take a little bit of a wind out of the sails of the quote unquote reopening trade. And the answer to that, to some extent, is to look at those quality growers. One of the things that I find interesting when folks are looking at the equity markets and they're worried about rising rates, and maybe they're worried a little bit about things like consumer spending, you hear this notion of, well, go to short duration equities. What does that even mean? I mean, a PE of 10 for a stock equates to a duration of 11, which is twice the aggregate bond index. So there's kind of no salvation in no growth equities. So I think you still have to count on some of the stalwarts who will show up with some growth, even in a little bit of a choppier market.